He turned 72 last year. Retired at 65, collecting full CPP and full old age security since then. He has a workplace pension of about $32,000 a year, enough to cover most of his expenses. In 2023, he decided to start drawing from his RRIF. His balance was sitting at $280,000, and his financial advisor told him the mandatory minimum withdrawal at age 72 was around $15,000. So he took it. CPP that year was roughly $16,000. OAS was about $8,500. His workplace pension was $32,000. Add the RRIF withdrawal of $15,000. Total income for 2023 was just over $71,000. He filed his taxes in April 2024. Everything looked fine. Then in July 2024, he received his OAS payment. It was lower than usual. Not by a huge amount, but enough to notice. About $60 less per month. He called Service Canada. They told him his OAS had been adjusted based on his 2023 income. He asked what that meant. They said his income exceeded the threshold for OAS recovery tax, and the CRA was clawing back part of his benefit. He had no idea what they were talking about. His income was $71,000. He was nowhere near rich. Why was the government taking back his OAS? I spent 28 years inside the Canada Revenue Agency. For the last 12 years, I worked in the Compliance and Benefits Division that processed OAS recovery tax calculations. I sat across from retirees who were confused, angry, and convinced there had been a mistake. There hadn't been a mistake. The system was working exactly as designed. The OAS clawback is one of the least understood rules in the Canadian retirement system. It applies to thousands of retirees every year, most of whom have no idea it exists until their OAS payment drops. And the threshold that triggers it, $90,997 in net income for 2024, is far easier to cross than most people realize. So let me explain exactly how this works, what counts as income, and what you can do to avoid losing OAS you've already earned. Let's start with the mechanism itself, because understanding how the clawback is calculated is the only way to see why it catches so many people. Old age security is a federal benefit paid to Canadian residents aged 65 and older. For 2024, the maximum monthly OAS payment is roughly $713 per month, or about $8,560 per year. You don't need to have worked to receive it. You don't need to have contributed to anything. If you lived in Canada for at least 10 years after age 18, you qualify for a partial benefit. If you lived in Canada for 40 years after age 18, you qualify for the full amount. OAS is not means tested when you apply. Whether you have $10,000 in savings or $10 million, you receive the same OAS payment at age 65. But it is income tested after you receive it. That happens through something called the OAS recovery tax, also known as the clawback. Here's how it works. If your net income on line $23,600 of your tax return exceeds the threshold, currently $90,997 for 2024, the CRA calculates a recovery tax of 15% on every dollar above that line. That recovery tax is deducted from your OAS payment starting in July of the following year. Let me show you the math. Your net income is $95,000. The threshold is $90,997. You are over by $4,003. The recovery tax is 15% of $4,003, which is $600. The CRA will reduce your OAS payments by $600 over the 12 months from July to June of the following year. That works out to $50 per month less in OAS. If your income is high enough, the clawback can eliminate your OAS entirely. For 2024, if your net income exceeds approximately $148,000, your OAS is reduced to zero. You still receive the payment initially, but the CRA claws back 100% of it through the recovery tax. Now, here's the part that catches people. The clawback is based on your prior year income, but it's applied to your current year OAS payments. You file your 2023 tax return in April 2024. The CRA calculates your recovery tax based on your 2023 income. Starting in July 2024, they reduce your OAS payments to recover that tax over the next 12 months. The lag means you don't see the impact of a high-income year until months after it happens. And by that point, there's nothing you can do to reverse it. The man I mentioned at the start had income of $71,000 in 2023. That's well below the $90,997 threshold. So why was his OAS reduced? Because I simplified the example to make a point. His actual income was higher. When I asked him to pull his notice of assessment, his net income on line $23,600 was $92,400. He had forgotten about a small rental property he owned. The rental income, after expenses, added another $21,000 to his total. That pushed him over the threshold by $1,403. The recovery tax was $210. His OAS dropped by about $17 per month for the year.
It wasn't a huge amount, but it was entirely avoidable if he had understood how the calculation worked.
So let's talk about what actually counts as income for OAS clawback purposes. The CRA uses your net income, line 23,600 on your tax return. That includes employment income, self-employment income, CPP and OAS itself, workplace pensions, RRIF and RRSP withdrawals, rental income, investment income from non-registered accounts like interest, dividends, and capital gains, and any other taxable income reported on your return. What it does not include is TFSA withdrawals, which are tax-free and don't appear on your return, the guaranteed income supplement, which is not taxable, and any income that is specifically excluded from net income, like certain disability benefits. The most common income sources that push retirees over the threshold are RRIF withdrawals, part-time employment, rental income, and capital gains from selling investments or property.
Let me walk through a real scenario I reviewed during my time at CRA.
A woman, age 68, retired, receiving CPP of $14,000 per year and OAS of $8,500. She had a small workplace pension of $18,000. Total income so far is $40,500, well below the threshold. But she also had a RRIF with a balance of $420,000. The mandatory minimum withdrawal at age 68 was roughly $22,000. Add that in. Total income is now $62,500, still below the threshold. But then she sold some stocks in her non-registered account. The sale triggered a capital gain of $65,000. At a 50% inclusion rate, that added $32,500 to her taxable income. Her total net income for the year was $95,000. She exceeded the threshold by $4,003. The recovery tax was $600. She lost $50 per month in OAS for the following year. She had no idea the stock sale would trigger a clawback. Her financial advisor never mentioned it. The brokerage never mentioned it. She found out in July when her OAS payment dropped.
This is the pattern I saw over and over. People managing their income carefully, staying under the threshold, and then triggering it with a one-time event they didn't plan for. A capital gain from selling property, a larger than expected RRIF withdrawal, a bonus or severance payment if they were still working part-time. By the time the clawback hits, the income has already been earned and reported. There's no way to undo it. So what can you actually do to avoid the clawback? Let me give you 5 strategies. First, if you're still working part-time or consulting after age 65, track your income throughout the year. If you're getting close to $90,997, consider deferring income to the next year if possible. Invoice in January instead of December. Delay a contract start date. The goal is to spread income across multiple years to stay under the threshold each year, rather than spiking over it in one year. Second, if you have a RRIF and you're taking more than the minimum, consider whether you actually need that income in the current year. Every dollar you withdraw from your RRIF is taxable income. If that withdrawal pushes you over the threshold, you're losing 15 cents per dollar in OAS on top of the regular income tax. That's a combined marginal rate that can exceed 45% depending on your province. If you don't need the money, leave it in the RRIF. Third, if you're planning to sell investments or property, be strategic about the timing. A large capital gain in one year can push you over the threshold, even if your regular income is modest. Consider spreading the sale across multiple years if possible, or using capital losses to offset gains. Fourth, maximize your TFSA contributions. Any money you hold inside a TFSA grows tax-free, and withdrawals don't count as income. If you have savings sitting in a non-registered account generating interest or dividends, consider moving it into your TFSA. That income disappears from your tax return and can't push you toward the clawback threshold. And fifth, if you're married or in a common law relationship, consider pension income splitting. You can transfer up to 50% of eligible pension income to your spouse for tax purposes. If one of you is over the threshold and the other is well below it, splitting income can bring both of you under the line and eliminate the clawback entirely. Let me show you how pension splitting works in practice. A couple, both age 70. He has a workplace pension of $48,000 and a RRIF generating $20,000 per year. His total income is $68,000 before CPP and OAS. Add CPP of $15,000 and OAS of $8,500. His total income is $91,500. He's over the threshold by $503. He'll lose about $75 in OAS. She has no workplace pension, CPP of $10,000, and OAS of $8,500. Her total income is $18,500. Well below the threshold. Without pension splitting, he loses OAS and she has room to spare. With pension splitting, he transfers $24,000 of his RRIF income to her return. His income drops to $67,500. Her income rises to $42,500. Both are now under the threshold. He keeps his full OAS. The couple saves the $75 clawback, plus they save on regular income tax because the income shifted from his higher marginal rate to her lower rate. The combined tax savings can be over $3,000 a year. Pension splitting is filed on Form T1032 with your tax return. It's simple, it's free, and it's one of the most underused strategies in the retirement tax system. Now, let me address one thing I hear constantly. Is the OAS clawback fair? People argue that they paid taxes their whole lives, that OAS is a benefit they earned, and that clawing it back based on income is punishing success. I'm not here to defend or criticize the policy. I'm here to explain how it works. But I will say this.
OAS is funded from general tax revenue, not from contributions. It's a social benefit designed to provide income support to seniors. The clawback ensures that higher income retirees receive less of that support, which allows the government to direct more resources to lower income seniors through programs like the Guaranteed Income Supplement. You can disagree with that design. Many people do, but the clawback is not a secret penalty. It's written into the Old Age Security Act. It's been in place since 1989. And it applies automatically based on the income you report. Whether it's fair or not, it exists, and it's enforced. What frustrates me is not the policy itself, but the fact that so few people know about it until they're already caught by it. Service Canada does not explain the clawback when you apply for OAS. They don't send a letter warning you that your income is approaching the threshold. The CRA doesn't flag it on your tax return until after the fact. You find out when your OAS payment drops, and by then it's too late to do anything about the income that triggered it. That's the gap I'm trying to close with this video. Let me tell you about one case that still bothers me. A man, age 73, widowed, living on CPP, OAS, and a modest RRIF. His income was usually around $50,000 a year, well under the threshold. In 2021, he sold the family cottage. He and his late wife had owned it for 40 years. The sale price was $680,000. The adjusted cost base was $120,000. The capital gain was $560,000. He designated the cottage as his principal residence for part of the ownership period, which sheltered some of the gain. But the taxable portion still came to $140,000. At a 50% inclusion rate, that added $70,000 to his income. His total income for 2021 was $120,000. He exceeded the OAS threshold by nearly $30,000. The recovery tax was $4,500. His OAS was reduced to zero for the following year. He lost the entire $8,500 benefit. When he came to see me, he was devastated. The cottage sale was emotional enough. It was the last piece of his life with his wife. And now the government was taking his OAS because he sold it. He asked if there was anything he could have done differently. The answer was yes. If he had known about the clawback, he could have planned the sale differently. He could have structured it as a multi-year transaction, selling a partial interest one year and the rest the next, to spread the gain across 2 tax years. Or he could have used a different principal residence designation strategy to minimize the taxable portion. But he didn't know, and his real estate lawyer didn't mention it, and his accountant didn't catch it until the return was filed. By then, the sale was done, the income was reported, and the clawback was automatic. He eventually got his OAS back the following year when his income returned to normal. But he lost a full year of benefits, $8,500, because of one transaction he didn't structure properly. That is what I mean when I say this rule catches people who have done nothing wrong. So here's what I'd suggest you do this week. First, pull your most recent notice of assessment and look at line 23,600, your net income. If it's anywhere above $85,000, you need to start planning. You're close enough to the threshold that one unexpected income event could push you over. Second, if you have a RRIF, calculate what your mandatory minimum withdrawal will be for the next few years. Add that to your other income sources, CPP, OAS, pension, rental income, and see where you land.
If you're approaching $90,997, talk to a financial planner about strategies to manage the withdrawals. Third, if you sold property, investments, or received any one-time income this year, estimate the tax impact now. Don't wait until you file your return.
If the sale pushed you over the threshold, at least you'll know the clawback is coming, and you can budget for the reduced OAS payments starting next July. Fourth, if you're married, look at pension income splitting. Run the numbers with and without splitting to see the impact on both your tax bills and your OAS. In many cases, splitting saves you more than just the clawback. It reduces your overall family tax bill. And fifth, maximize your TFSA. If you have contribution room, use it. Every dollar of investment income you can shelter in a TFSA is a dollar that won't push you toward the clawback threshold. The OAS clawback is not going away. The threshold is indexed to inflation, so it increases slightly each year, but the structure remains the same. If your income exceeds the line, you lose 15 cents per dollar in OAS until the benefit is gone. The CRA expects you to know this. They don't warn you. They don't send reminders. They calculate the recovery tax based on your income, and they deduct it from your payments automatically. I should say clearly, I'm a retired civil servant, not a licensed financial planner. For your specific situation, consult a CPA or financial advisor who can review your actual income and help you plan. What I've given you here is the framework, the threshold, the calculation, and the strategies that work. The man I mentioned at the start, the one whose OAS dropped by $17 per month, now tracks his income carefully. He sold the rental property to simplify his tax situation. His income is back under the threshold, and his OAS is back to the full amount. But he wishes someone had explained the clawback to him before he crossed the line, not after.